Hello everyone and welcome to the special online briefing for the Safe Money Report. I'm Mike Bernick, Director of Research here at Weiss, and with me again, as always, Bill Hall, the editor of the Safe Money Report. Hey Bill.
Hey Mike, it's great to be here.
Thanks for joining us live in the studio. Always great to have you here in person. And let's dive right in because as usual, you've got some great charts for us that point out what's going on in the market, the major trends in the market with stocks, bonds, gold, you name it. So first of all, we'll start where we always do, where you start every morning, the Safe Money Scoreboard, to see where we're at right now.
That's right, Mike. Every morning when I come in and do my job as a professional money manager, I start with a dashboard, or what I call the Safe Money Scoreboard for our purposes here, so I can get a sense of what's going on in the market. What is actually happening in the market? Because by looking at what's happening in the market, I can get my hands around the underlying themes in the market. So the things that jump right out at me when I look at this scoreboard, and it's the theme that's sort of continued all year this year, is that growth continues to be the dominant force in this market. And how do I know that? Well, if you look at the S&P 500 ETF here, you see that the year-to-date performance is about 17%. But if you look at the Russell 1000 growth, you see that we're well over 20%, almost 23% on the Russell 1000 growth. Then you look at the emerging markets, which is where all the GDP growth is, and you see 32%. Plus, so you're more than 30% in the emerging markets. So the theme is, Mike, go where the growth is.
Yeah, indeed. Most asset classes are doing real well this year. A lot of investors, though, think that maybe it's not going to last, but so far so good.
Absolutely. And this is why they think it's not going to last. I don't agree with this, but this chart shows us why we think it's not, that a lot of investors think it's going to last. And this is a chart that shows valuation levels. This tells you whether how expensive stocks are as a group. It's sort of like a gallon of gas, Mike. You know, when you go buy a gallon of gas and it's $4 a gallon, that's expensive. If you go buy a gallon of gas and it's $1.80 a gallon, that's cheap. So what this chart that we have here shows us, the Shiller PE chart, shows us just how expensive stocks are right now. And you can see that we are in the second most expensive time in history, meaning people are willing to pay a lot for stocks. We're not where we were with the internet bubble just yet, but we're well above the subprime crisis, and we've gone above where we were in the 1930s with Black Tuesday.
Indeed, and I think one of the reasons you point to for the fact that valuations are okay being stretched is the low interest rate environment we have.
You're right on track here. I call it the magic metric. I've been saying that for most of the year. My magic metric, if you want to know what's going on in the financial markets, look at the 10-year Treasury. The 10-year Treasury will tell you everything that you need to know. And right now, we're sitting at 2.38%. I was one of the few people that thought interest rates were going to go down this year. And that's what's happened. We've actually trended down about 2.16% on the 10-year Treasury. We started out the year at 2.42%. We're down to 2.38%. And this is my favorite chart. And if you take nothing away from this webinar today, you should understand what's happening here. I've put interest rates into three groups. Or three ranges, range 1, 2, and 3. And the middle range, as you can see, between 2.3 and 2.7% is what I call the sweet spot. And as long as interest rates stay in that area, we are going to see stocks continue to climb higher.
What would happen in your estimation if we see rates go above that into range 1, 2.7% or even beyond, like 3%?
If we went up that high, Mike, in my view, one of two things could happen. What we've got rampant inflation, and I would think stocks would go down in that environment, or we really have busted out on the upside in terms of growth. That Donald Trump and the Trump administration have played their 4 Trump cards and made America great again. That economic growth and GDP growth have really started to pick up, and the stock market will go higher. So range 1, if we get in that range, we could have one of two things happen. Markets go down or markets go up. But the range we really have to worry about, the one that I am really concerned about, is range 3. As you know, in the past we've talked a lot about deflation.
Right.
The big D.
That's right.
And I believe that deflation is much more of a concern globally than inflation right now.
Okay. And so for the trade-off right now for stocks versus bonds, it's clearly stocks in your opinion.
Yes, in my opinion, this is all you need to know. If you have a 10-year treasury that's yielding 2.5%, you're going to get no growth in that. That means you're going to give the U.S. government, let's say, $10,000, and for 10 years you're going to collect $250 a year and then get your $10,000 back. Or you can buy a growth stock, a great growth stock. Some of the best growth stocks out there, we hold them in the safe money portfolio. Stocks like Google, stocks like 3M, stocks like United Healthcare. Those stocks pay dividends of around 2% and you get growth. That's the trade-off. That's what all the professional money managers are talking about, and that's why the stock market's going up.
Right. And another contributing factor here for low interest rates is the kind of softness we've seen in the global economy, at least not as strong a recovery as we've seen, in past decades.
And you said it just a minute ago. It's because of the big D. Mm-hmm. It's big D is deflation, and we've talked about that in the past. And because we have these deflationary forces out there, primarily because of the huge debt loads that are prevalent in the economy today,
right.
We've had a very slow growth economy.
All right, and then of course this focuses on really where the performance is in the market. This next chart, it's all about growth, just as you said.
Right, and this sort of takes us back to our first chart, which was more numbers on the screen. This is arrays it in terms of a bar graph, and what it shows you in the blue area is the growth-oriented investments, and they are clearly outperforming value-oriented investments. So again, growth is great again in the U.S., and that is what you want to do, is go where the growth is in a slow-growing economy with low interest rates.
Yeah, growth is definitely beating value by a very wide margin, as we can see. And now this next slide is one of my favorites. You include it every time. What's going on with the three wizards that are engineering all of this for us?
The wizards behind the curtain.
Right.
These are the people that are in charge right now. They have their hands firmly on the wheel of the global economy and the global stock markets. And what we have here, of course, is Janet Yellen of the Fed, Mario Draghi of the ECB, and the head of the Bank of Japan. And these people, with their magic money machines, are continuing to create an environment of low interest rates and easy money, and in that environment we are going to have a stock market that continues to go up. And the reason why they're doing this is because they don't want to deal with the social impact of letting the economies fail, to let real capitalism work. So we are in an over-indebted economy. The only way to keep things going is low interest rates and easy monetary policy.
Exactly, and also we're in a record low volatility environment right now.
Well, our three wizards have concocted this environment too, with again, their magic money machines. The markets have started to figure it out. As long as interest rates stay low and as long as monetary policy remains easy, what we're going to see is record low volatility. We're going to see the market just continue to go higher and higher and higher.
Okay. And this next slide is an interesting one. It kind of ties back to your magic metric, being the 10-year Treasury bond yield.
Yes, and what this chart talks about, and why I wanted to put this in, it's so timely, because we're hearing about how the Fed is going to raise interest rates, or how the ECB is going to raise interest rates, or how the Fed is going to tighten its balance sheet, or let things run off its balance sheet. They're going to shrink their balance sheet. Look, the Fed isn't crazy. They know this. They know if they invert the yield curve, that means if they drive up short rates till they run into the 10-year Treasury yield, they are going to cause a recession. And this chart is a little hard to read on the screen, but what's important with the chart is that we have a ways to go before the yield curve inverts or gets flat. But if it does, we're going to end up with a recession. But my three wizards, they know that already, and the three wizards are not going to let that happen, especially not on their watch.
And therefore we have, as you put it, the unstoppable S&P.
Yes, and we are on a long bull run, but as you can see, we've had a longer bull run that began in October of 1990 and actually went through March of 2000. So yes, we're on a long bull run, but we've had ones that have gone 113 months. I think we're into the 95th or the 96th month here. We have a ways to go. But the other important thing here, Mike, is we are in a world of experimental monetary policy. My three wizards have come up with this easy money policy for as far as the eye can see. So this thing is going to go a lot longer than the last big bull run went.
Interesting. Unless we see a black swan event. You're on the watch out for that, right?
Well, you know me. I am the captain of the safe money ship here
Right.
at Weiss. And as the captain of the safe money ship, what I always have to be worried about is protecting the downside. And what I'm looking for is those high impact events that are unlikely but high impact that could tear the markets apart and threaten the wizards' control of the markets.
And what are some of those events that you're keeping an eye on?
The ones that I really worry about are and I've talked about this in my in some issues that I wrote earlier this year, is I'm really worried with all the debt out there in the world that we have some crack in the global bond markets. And by that I mean is some bank in Europe or Asia, I think it's more likely that it happens in Asia, all of a sudden has a problem where they can't make a payment to another bank. All these global banks are interrelated,
yeah.
right? They're interrelated with derivatives, all kinds of things. And what I worry about is that somebody can't make good on a payment. Then we realize that we have a bigger problem than we thought we did, that the Fed and the ECB and the Bank of Japan can't get in the way of it, and then we have a credit crunch, which then takes financial assets down across the board.
Yeah, kind of a domino effect like in 2007, 2008, but maybe starting in Asia this time.
That's where I think it may go.
That is something to watch out for. In the meantime, though, let's end on this sage quote from a famous money manager I know.
well, thank you for that, Mike. But as the editor of the Safe Money Report, it's important for me to remind everybody that your investment capital is precious. And so this is a quote that I keep above on my desk or on the wall above my desk, and it says, "Remember, money can come as quickly as it goes, but once it is gone, it rarely comes back."
How true.
Right. So therefore, the first rule of making money is don't lose it.
Right, exactly. Well, thanks, Bill. That was a great presentation. And now we'll shift into the Q&A portion of the webinar here and take some of your most pressing questions from our readers at home. And I'd like to thank you one and all for sending in the questions. Obviously, we get hundreds of them all the time. So what we've done is select some representative questions, some of the same ones we see over and over about things that are on our readers' minds. We're definitely going to touch base there. And feel free to keep sending your questions into the Safe Money Report editor's mailbag that you'll find right on our website. So thank you very much for that.
You know, I really enjoy these questions because they really make me focus my thinking too. So I appreciate our subscribers send them in.
Absolutely. This is my favorite part of the presentation. So the first question comes from Bob, who says, when is gold heading north in a sustained manner? When will it break out of this 2-year trough? Thank you, Bob.
Well, what I would say to Bob is, in my view, I think we are in a financial asset melt up right now, and I don't see an environment where gold makes a big move on the upside in the next 2 years. That doesn't mean that you're not going to get opportunities to trade it. Gold will be volatile, but what I'm using gold for in the Safe Money Report is I'm using it as a hedge to hedge downside risk. I'm not looking for a ton of appreciation out of my gold holding.
Okay. Let's take another question. This one comes from Anne Marie. She says, can you give us more clarity? What type of events are the forces that would make TLT more valuable, especially now that Japan and other countries seem to be increasing their national debts? Well, it's not just Japan, is it, Bill? I mean, the entire world, as you said, is deeper in debt now than we were even in 2008 during the financial crisis.
Yes, Mike, you're absolutely right when you say that. A lot of people think that we have less debt out there than we did in 2008. In fact, what's happened, and again, I've written about this, is that we have more debt out there. And I believe that TLT will continue to it will increase somewhat in value. I think we are range bound with interest rates. I think we're going to be in that range too that I showed you, somewhere between 2.6 and on the downside maybe 2.2. So again, the reason I am holding TLT is to protect the downside in my safe money portfolio.
Right.
So when TLT will go up, when we have a crisis like we did with the North Korean missile crisis. You saw rates go down, or the 10-year Treasury fall to 2.16%, TLT went up. So again, TLT, I am using it as downside protection.
Okay, good hedge along with gold. Let's see, another question. This one comes from Joe. Joe says, Bill, Martin Weiss has been warning about the potential collapse of the bond market. Martin mentioned the fact that Janet Yellen is tapering the Fed's balance sheet, and Martin specifically mentioned the 20-year Treasury bond might be affected. You suggested buying the long 20-year Treasury bond ETF, TLT, that you just talked about, because the Treasury yield will fall prior to a stock pullback. But do you still stand by the suggestion?
I do, and I don't think Martin and I are that far off. I mean, I'm worried about that at some point, this magical money machine that my three wizards are cranking along.
What if it breaks down, right?
If it breaks down, this is what Martin's talking about, that we are going to have a collapse in the sovereign debt market. I think that's, in my view, is that's not, I don't see that happening in the short run. I think that's a long-term phenomenon. You need to be aware of it. You need to be vigilant for it. You need to watch for it like a hawk. Like I said, I was watching the global credit markets. But for now, I believe that the 20-year Treasury or the 20-year Treasury bond ETF, TLT, is a good place to put your money to protect the downside. And the best part about it is, unlike gold, at least you make some money with the interest payment. You get paid a dividend every month. And right now that's running around 2.5%. So I get to protect the downside of my portfolio and I get a check every month. It doesn't get any better than that.
Okay, standing by TLT. Next question from Jack. He says, I'm thinking about going to all cash, no stocks for the next 2 months. What do you think of that? The time to check out of the market entirely?
Well, Jack, I think everybody has to invest according to their own risk profile. I'll say that first. But I think right now, stepping out of the market would be a terrible mistake. I think we are going to have a big run as we close out this year. I think that we have, the Fed came out yesterday, said no change to its interest rate policies. I think we're going to get a big run between now and the end of the year, especially as professional portfolio managers who've missed out on this run so far try to make up ground in the last 2 months of the year.
Good point. We are in the seasonally strong part of the year, so we'll see. All right, let's take another question. This one comes from Cheryl. She says, would now be a good time to buy GLD? I started late to the program, so did not get in when it was cheaper. Thank you, Cheryl.
I think the best way to answer Cheryl's question is, Cheryl, you should follow my recommendations in the safe money portfolio. Right now, I have a buy on a 5% position in gold. So I am saying buy up to 5%, but it's not an a la carte menu in the safe money portfolio. Everything's meant to work together. So you're going to buy a 5% position in gold. You need to buy the growth stocks that I've talked about, and then you need to look at the pieces that are in the profit accelerator. So yes, you need to buy gold, and you should buy a 5% position in conjunction with everything else at this point in time.
Okay. Let's take another question from Clay. He says, when does one take capital gains on dividend stocks versus holding for dividend income, especially with higher taxes on cap gains versus dividend? If you make a profit, shouldn't you take it versus trying to break even at tax time? What's your advice on tax ramifications there, Bill?
Well, Clay, or Mike, and to Clay's question is, I'm a CPA. And so I understand exactly what Clay is getting at here. But what I can tell you is that what you need to do when you're as an investor is you need to think about tax considerations second. The first thing you need to think about is, do I like this stock? Do I think this stock is going to go up more? Instead of worrying about when I should take my gains or my losses. When you decide to go from a stock because either it's performed really well and you want to trim it back, or you've got a loss, that's when you think about tax ramifications. But do not let the tax tail wag the dog.
Don't put the cart before the horse, in other words, right?
Absolutely.
Okay, let's take another question. This one comes from Hugh and Charity. We live near the U.S.-Canadian border. So far, it isn't hard to shop both sides. Do you expect border crossing regulations to be changed in the near future, making it harder to take valuables across? Any ideas on that, Bill? I know you live pretty close to the Canadian border yourself up there in Maine.
Yes, I have a house in Maine, and that's where my family is. And my view is that Canada is an open trade partner with the U.S. I think it's our biggest trade partner.
Yeah.
Last time I checked, is that right, Mike?
Yes, it is.
So Canada's our biggest trade partner. They're also a friendly trade partner. So I'm not an expert in any way on border regulations and border crossings. But what I can do know is that from a macro standpoint, I don't see anything affecting our ability to move goods and services back across the border with one of our most friendly and our largest trading ally, Canada.
Okay. This question, next one comes from Marcella. Another question about precious metals. When do you think gold and silver will go up? You mentioned before, Bill, that you didn't think, the next year or two you'd see a big move. When do you think gold will finally shine again, in your view?
I think gold will shine again when the stock market and the bond market collapse. I think that a collapse will start. Let me be clear here. The black swan events, we talked about that. So I think a collapse in the financial markets will start with a credit freeze up, which will then spread to the bond market and then spill over into the stock market. And that is when gold and silver will go up. That is why I am watching interest rates like a hawk. That's why the 10-year Treasury is my magic metric. That is why I haven't gotten into this in this webinar, because it gets complicated, is you're looking at credit spreads. I'm looking at credit spreads between junk debt and the 10-year Treasury. I'm looking at credit spreads between Spanish debt and the U.S. Treasury. Looking at credit spreads, looking at interest rates all the time, because if I see those rates start to plummet, is what I told you I thought we'd have a problem. If it'll indicate if what I'm saying is right. If interest rates in the U.S. start to plummet, that means there will be we're seeing a flight to capital to the safe haven U.S. and a blow up across the rest of the world, and that's when gold and silver will go up. But the bottom line is I don't see it happening for a while.
Okay. Let's see. Next question comes from Suzanne. She asks, in the next 3 or more years, will certificates of deposit be a safe place to keep money? If the country goes into a depression, will CDs no longer be a safe investment?
I believe that CDs are a safe investment and will continue to be a safe investment for at least the next 3 years. That's because the U.S. economy is vast and deep. It is the world's safe haven currency right now. It's the dollar is the world's reserve currency. Yes, we may be the best house on a bad block. You've heard me say that before. The world is over leveraged, but for right now, for the next 5 years or so, I don't see any major issues on the horizon.
Okay. Although CDs don't pay that much these days because of the low interest rate environment. But other than that, they're safe enough, huh?
Yes, they're safe, but you're not going to make any money.
Exactly. Let's see. Another question comes from Lyle. He asks, there hasn't been much said about where real estate values are possibly headed. I live in Hawaii. It's a nice state. And the prices here have been pretty much following the stock market up. Do you see prices continue to rise, or do you see a steep decline for real estate after interest rates start rising?
Well, Lyle and Mike, the way I look at real estate is the prices of real estate are a function of wages in any particular area. So the more money people make in a particular area, other than a few, like Hawaii is one of them, because it is a destination for people to have vacation homes. Miami is another place that is not tied to wage growth, real estate prices. So in these destination places where people are looking to park money outside of the stock market, I see real estate prices continuing to rise because I believe interest rates are going to be low. In other areas, let's say for like Cleveland, Ohio, for example, real estate prices there, or in Buffalo, New York, are going to be a function of wage growth in those particular economies. But again, in these destination areas where people, again, are looking to park money outside of the stock market, I think you're going to see real estate prices continue to rise because interest rates are going to stay lower longer than everyone expects.
Okay. Good straight answer. And that's about all the time we have for today's presentation, but we'd like to thank one and all for the great questions and comments you sent in. And as I said before, please feel free to keep those questions coming via the Safe Money Report editor's mailbag, which you'll see right on our website. You can type in your questions and send it directly our way. And with that said, I'd like to thank you all for attending today's presentation. And Bill, thanks for your time as well. Great seeing you.
Yes, it's always a lot of fun to be here with you, Mike, and thanks to all our subscribers. And keep an eye on your safe money portfolio because I think it's going to go through the roof.
Thanks, everyone, and good investing.